Wall Street has been trying to survive in the chamber of horrors. The culprit for the fear is a looming recession in the United States and a global economic slowdown. Investors are overwhelmed by the ghost of troubled times, but the market is eager to regain confidence. Despite a volatile session yesterday, Wall Street closed with minor changes. The benchmark stock index is closed in the red because investors digested a series of gloomy forecasts. Stock investors seem to be fed up with the fears. Wall Street was on the defensive yesterday. The Dow Jones closed flat. The Nasdaq shed 0.51%. The S&P 500 slipped 0.91% to close at 3,933. The New York market was a bit more optimistic. The major stock indexes tried to regain their footing and printed modest growth. The S&P 500 is expected to trade in the same intraday corridor between 3,890 and 3,990 points. The S&P 500 closed with losses for the session's trade. 8 out of its 11 sectors went down, with the communications stocks showing the worst performance. The energy stocks were also under the spotlight due to another fall in the WTI prices, which settled at the lowest level in 2022. 3 out of the 11 sectors in the S&P 500 gained ground, including the healthcare sector. The high-tech stocks remain under selling pressure. The Nasdaq extended its losing streak for 4 sessions in a row. The market sentiment was spoiled by top companies. Apple shares stumbled 1.4% due to lower-than-expected data predicted by Morgan Stanley in terms of iPhone sales. Tesla shares dropped by 2.3% because of worries about manufacturing failures. The VIX index closed at 22.68 yesterday, at the highest mark since November 18. Investors were alarmed by grim forecasts by top American banks, which warned about a looming recession. Banks and Wall Street executives urge investors to brace for painful losses next year and a recession which is sure to affect major economies. Concerns were aggravated by the weak trade balance data in China, even though Beijing is relaxing its economic COVID restrictions. The common viewpoint among Wall Street experts is a slowdown in the domestic economy, a decline in consumer activity, and weak corporate profits under simmering inflationary pressure. And in this context, investors are stoking fears that the US Fed may extend its cycle of rate hikes. The Bank of Canada managed to send hawkish and dovish signals at the same time. The regulator raised the key interest rate by 50 basis points, promising to soften its rhetoric. This move revived hopes that central banks are also spooked by a sudden burst of recession worries. The US Fed will hardly find it appropriate to revise its extremely hawkish rhetoric. The regulator is still determined to increase the official fund rate by 50 basis points next week. Market participants are alert to a series of economic data such as the weekly unemployment claims, the US PPI, the Consumer Confidence Survey by the University of Michigan, and they will look for clues as to the Fed's policy decision on December 14. The number of Americans filing for unemployment benefits rose slightly by 5,000 to 230,000 last week, in line with the expectations. This minor growth indicates tensions in the labor market. It might wreck the market attempts to recover. The US dollar index is drifting lower today, having edged down 0.5%. The index consolidated at around 105, but it's hesitant to cross the level. The intraday for the index is seen between 104.70 and 105.40. The currency market is trading quietly without high-impact events and catalysts. The market might wake up on a Friday, but all eyes are on the crucial event of the next week. Market participants are trying to puzzle out whether inflation has reached its peak. If so, central banks have more leverage to moderate the pace of rate hikes in the nearest months. The report on the U.S. consumer inflation will be published the day before the Fed's policy meeting, and it could play a key role for the market to shape long-term expectations for monetary policy. The U.S. CPI is the most important metric to matter a lot for the US dollar's outlook. Until it is published, it's early to predict the greenback's rally. The battered Canadian dollar is ready to assert its strength. The USD card pair dipped 0.47% to trade at 1.3585. Despite hawkish and dovish signals sent by the Bank of Canada, the catalyst for the looney's optimism is oil. The currency pair is likely to trade in the corridor between 1.3520 and 1.3610 today. On a Wednesday, the Bank of Canada raised the overnight target rate by half of a percentage point to 4.25%, the highest level in almost 15 years. The regulator sent a message that monetary tightening is coming to an end. The central bank explained its rate hike by robust economic growth and tense labor conditions. The Canadian GDP expanded by 2.9% in the third quarter, stronger than expected. The economy still reveals excessive demand. Yesterday, the benchmark oil grades slumped. Yesterday, Brent crude plummeted to the lows of 2020, the levels below $77. Afterwards, oil prices reversed their trajectory. Today, the loonie is propped up by the rally in the oil market. Brent crude gained 2.14% to trade at $78.81 a barrel, and WTI rebounded 3.8%. The crypto market has been locked in trading ranges. Cryptocurrencies are trading sluggishly, wavering between dips and gains. Bitcoin is hovering at around $16,800. The information background does not encourage optimism. Binance CEO branded former FTX CEO Sam Bankman-Fried one of the greatest fraudsters in the history. A U.S. bankruptcy judge ruled on Wednesday that some customers of a crypto lender Celsius network should receive their deposits. The intraday forecast for Bitcoin remains the same. The token is expected to trade within the range between $16,800 and $17,200 until one of the borders is broken. Good luck and see you tomorrow.